All right, welcome back, everybody. Today we have a super amazing guest with us today, Tavi Costa. Tavi is a portfolio manager over at Crescat Capital, and they do global macro investing over there. And there is a lot happening in the world today. And so I wanted to get Tavi on and get his perspective on a lot of different things. So Tavi, welcome.
Hi, Tony. Thanks for having me. Looking forward to this conversation.
Yeah, this is going to be fun. We're going to cover a lot of ground. If you could, maybe give the viewers a 50,000-foot view executive summary of what's happening in the global macro space today.
I think there's a lot of things going on. I think we're seeing the unleash of a lot of macro trends currently that are all linked to big macro imbalances that we have in the global economy. I've talked about the trifecta of the macro imbalances that we have, the 1940s type of debt issue with the inflationary problems of the 1970s, along with the valuation problem of the tech bubble times in the late 90s. And that sort of creates the stage for a lot of things that can be unleashed. And some of them are the commodities to equity ratio that we're seeing recently starting to perform very well. We've had recently as well the imbalances created in the credit markets with the percentage of yield curve inversions going above 70%. That means that you want to own gold and sell stocks. So the gold to S&P 500 ratio has been on the rise since November when we got that signal. That is an important trend as well. We have parts of the commodity markets starting to move and others that still have to start moving. So we've had 2 years of bullish period in the energy space, but we haven't seen that yet translating into other parts of the commodity markets. And we're starting to see that on gold, other mining stocks as well. I think that can be even spilled over agricultural commodities again. So most of commodities had a big run up in 2020. Some of them went over to 2021, and then we had sort of a consolidation period. And now I think you're probably going to have it much higher. And in my view, if I could point out to the most important thing going on for the next couple months is likely to be the debt ceiling. I understand that's been it's been very wrong to be concerned about the debt ceiling from a market perspective. It's been completely irrelevant for financial markets what happens with the debt ceiling. But I feel very confident that this time it's actually going to be incredibly important. And the reason for that, it has to do with the fact that the government's running out of cash. We've had that happen in the past. So the cash that the Treasury holds for day-to-day operations is running really low. It's below $100 billion right now, or very close to $100 billion currently. And if we've seen that balance run very low in prior times, usually tends to happen on the back of that is that you have a massive issuance of treasuries. And my big question is not necessarily on the default risk of the US over those treasuries or those debt commitments. It really is on the back of Republicans and Democrats, in fact, agreeing to increase or extend the debt limit. And that will create a huge amount of debt issuances, because every time we've had this pause on debt issuances caused by disagreements in debt ceiling, we've had a spike in debt coming out of that, which makes sense. But the problem is, how would the market absorb that? How would the market absorb maybe $1 trillion of US Treasury issuances on the back of a year like we had in 2022 of the 60-40 portfolios completely collapsing? In other words, equities and bonds falling together, and the appetite for those securities is, in my view, under major pressure. So with the deglobalization, we can go on and why that. So that's my answer to your initial question. Yeah.
And I threw a lot at you all at once. That was very well said, very well put together, because each and every one of those topics are impacting us today. And we're going to dive into a few of those to add a little more clarity for the viewer. You mentioned, a little bit about a bubble. Where do you see, or do you see that we're in a bubble in certain areas? I know equities have come down some, real estate has come down some. Do you see that we're still in that bubble-licious territory for equities and maybe real estate? Do you think there's room for them to come down more?
Look, I don't want to sound extremely negative, but I just don't understand how anyone could justify the current multiples in overall equity markets today. I think it's one of the most frothy financial markets in terms of asset valuations that we've seen throughout history. And I say that because we really had, I did this research through decades, looking back in times when we've had very negative performances in overall markets, especially in the S&P 500. And really this happened over 5 decades. Some of those were inflationary periods, and the others were really times when valuations are very frothy. This is the first time we're facing both issues at once. Valuations are very frothy at a time when we also have inflation being a problem that is very different than what we saw over the last 3 to 4 decades.
And very high debt as well.
A very high debt as well, which is what we call the trifecta of macro imbalances. But high debt did not translate in low performance for equity markets necessarily. What translated into negative performance for equity markets really was on the back of those 2 periods. And so to me, that's the relevance of those 2 categories in terms of looking at multiples. And the main reason for that tends to be because on the inflation side, it has to do with the cost of capital being higher, inflation risk rises, the cost of debt itself starts to rise, and so end up seeing a big difference in terms of how you approach multiples at the beginning of the inflationary decades versus the very end. So you see multiple compression happening, not so much on the back of earnings falling, but really on the back of the discount rate being higher that causes those multiples to compress over time. And so, the average decline has been about 70% over inflationary periods when you look at just the impact of discount rates in multiples. But the problem is those multiples that we're looking back during those inflationary periods, as I said earlier, were not frothy periods. We're just inflationary problems. And so you're looking at times when we started those inflationary decades with CAPE ratios or cyclically adjusted PE ratios, looking at price versus fundamentals, starting at around 17, 15. Today, it's about double that amount. We're at 30. And so at the end of those decades, we were at single digits. If you just calculate the impact of going from 30 to a single digit number, even if it's a high single digit, let's just call it a 10 or 9, just for the sake of the argument, you're implying a huge decline here in terms of prices relative to fundamentals. The second question is, that's just the inflationary category. If you look at the valuation category, frothy valuations cause earnings recessions. Those are speculative times that tend to cause real contractions in earnings. And today we were at peak margins not too long ago. Margins are starting to contract. You looked at the earnings per share in nominal terms, so including, in this case, not adjusting for inflation, over the last 70 years, you find is that we've been in this channel for earnings per share in the S&P 500. And every time we hit this upper side of the channel, we have a critical juncture for the overall equity market where earnings tend to suffer. And we are at the critical juncture right now. It's hard to extrapolate how we're going to see, again, another decade of very strong growth in earnings. The 2010s, which was a prior decade, was by far the strongest growth in earnings we've seen in history, 120 years of history. The second and the third times that we've had these levels of increasing earnings were in 1920s and 1990s. Both of them preceded decades that we actually saw earnings contract as well. So there are many reasons for me to believe that earnings are probably at peak and we'll likely see major declines from current levels. If that is on the back of wages and salaries growth relative to profits, that is on the back of deglobalization, that is on the back of material costs being higher. All those things are probably going to have significant impact on fundamentals of companies at a time when most of the analysts are still expecting earnings to be at peak levels 2 years from now. I completely disagree with that call. We're going to have to learn how to value investments in this environment where rates are going to be higher and inflation is going to be higher. That will be a huge changes of leadership in markets, but also, in my opinion, big reflection of prices being a lot lower relative to fundamentals and multiples being compressed. So
for the viewers, this is what I love about, he does not look in the just what's happening in the short term, Tavi takes a look at what's been happening over decades, over the last 100 years. You hear him talking about the 1920s, the 1940s, the 1970s. Those were big periods of time in our history here. And we need to reflect on that. We need to go back to that, look for some similarities, look for some differences, and try to weave this story together. And, you hear Tavi talking about, geopolitical forces, right? We are in a globalized economy, as much as some folks, we're still trying to wrestle with deglobalization and how much of that is potentially going to happen going forward. But as of right now, we are in a very globalized economy, and we need to put that into the equation to see how that's going to affect us going forward here. You spoke about treasuries, and I'm curious what your take is on how much value do you add to the delta between the two tens. We are currently at about 50 bips of a delta there. We were, I think, maybe 2-3 weeks ago, we were actually at about 100 bips. That's the furthest I think they've ever been apart. How much value do you put in the two tens?
I think the 2 10s and the 3 month versus 10-year yield spreads are great places to start when you're looking for leading indicators for markets. But it is difficult for money managers to use that as a gauge for how to position your portfolio, because you get different signals depending on the time. So 2008, we've had a inversion of the yield curve about 2 years prior to the real beginning of decline in equity markets, overall equity markets. In the 2000s, during the tech bust, we actually coincided with the inversions coincided with the decline in equity markets. So you have some very important differences in terms of how those signals can proceed or coincide with the decline in markets. Note that I'm not using the word recession, because recession for a money manager, it almost is irrelevant, because once you have a recession being assigned by the government, that just means you're probably near the bottom of the market. So in my opinion, the most successful and best form of measurement of looking at the credit market, it really is the percentage of inversions. I created this indicator back in 2018 that looks at all possible spreads in the yield curve. And I don't say this just because it was something I created. It's just because I think that the empirical analysis is as perfect as it gets when you're looking for a macro indicator to guide you as to position your portfolio in different times in history. And what I found from that research is that it's not necessarily the degree of the inversion, and not necessarily one or two spreads, but really looking at all spreads and seeing how many of those are inverted today. What you find is that every time you go above the 70% handle, which means if you look at all possible spreads, 70% of them are actually negative. That means you probably coincides with the beginning of a recessionary period, meaning a decline in equity markets and some issues start to emerge. So for positioning, this was interesting. Every time we all the way back to the 1970s, we went above 70% in this indicator. We've had a hard landing. But again, I'm saying hard landing. Hard landing doesn't really matter for a money manager. So we empirically went back and said, well, what are the best assets to own every time we hit the 70% handle? We looked at treasuries, we looked at oil, we looked at gold, we looked at S&P 500. And there are times when each of those asset classes will perform differently, even depending on the macro regime that you're in. The 70s was very different than the 2000s. One indicator or one positioning that was very clear was that the gold to S&P 500 ratio, in other words, buying gold and selling overall stocks, worked really well throughout all those times when we went above 70%. Some of those periods was on the back of gold going higher, and the S&P 500 also moving higher, but not as high as gold. Some other times we'd had gold declining, but the S&P 500 completely collapsed, and therefore that ratio went higher. And 2 times in history, all the way back to the 70s, that really occurred on the back of both parts of the leg of this trade really working. In other words, gold rising with the S&P 500 actually declining. I think that is incredibly relevant because to me, those 2 times were times when the commodities to equity ratio was also very depressed historically, meaning tangible assets are cheap relative to financial assets. And guess what? We have the same issue today. I think there's a case to be made that you can see gold rising with markets declining. And this can be play out very differently than how we saw back in 08 when most commodity producers completely collapse as you see the recession or the downturn unfolding. In my opinion, I think there's a huge case to be made where you may see this divergence between tangible assets and businesses that are involved or related to those underlying assets, commodities. And while you may see financial assets, including bonds, declining significantly from here. So the treasury market, it plays a huge, role into this view that I have. And I think the 60-40 portfolios also play a big role into this view. It's very crowded. And I think we're going to go away from those positions today into a portfolio that would be much more diversified, that will actually include things like commodities and things like gold as a true safe haven aspect of a portfolio moving forward.
Yeah. And again, another perspective for the viewers from the standpoint of a lot of folks have financial advisors. A lot of the viewers are going to be very familiar with a 60-40 portfolio. But what they don't get from financial advisors is this comparison to gold, this comparison to commodities, and making sure that you also have, especially during a period of recession, there's still opportunities out there, and the opportunities may be in the commodity space. But I want to ask you a little bit about gold. A lot of folks are scratching their head in this world of uncertainty, in this world of geopolitical issues, in this world where over the past few years, Russia and China have been stockpiling gold. Why hasn't gold trended higher? We're at about $2,000 an ounce right now. Okay. But folks are scratching their head. Why hasn't it trended higher? Is there some kinetic energy that's building up that's gonna, take this and explode the price of gold higher in the near future? I mean, what are your thoughts around that? And also, if you can share, if you want to share, where do you think gold will land?
I think it's very difficult to pinpoint a price for an asset in the future. I think the best way to think about this is looking at the real forces that are on the tailwind of this trend, which I think are probably the strongest and most robust that we've seen throughout history. If I tell you that central banks would be increasing their balance sheets the way they did, that we would see this chronic underperformance and underinvestments across natural resource industries, causing this shortage of materials, that would start seeing the level of government intervention from a fiscal perspective that we are seeing currently, the crowdedness of portfolios that cannot almost create flows towards technology and bonds and fixed income markets because of all this 20 to 30 years period that we've seen of capital just flocking into those markets. Would you think gold would be much higher? And I think it would be, but we've lived through the last decade or so of an easy money period that has created a sense of expected return that is just completely unrealistic. It bothers me when I see, for instance, the comparison with Bitcoin, because Bitcoin started from zero. Any asset that starts from zero will have an incredible return.
Yep.
And so comparing an asset that is the size of market cap of gold relative to the size of Bitcoin, it becomes almost irrelevant. You're not going to get rich buying gold. I mean, I'm not breaking any news to anyone here. You buy gold the same way you buy treasuries, to protect capital. The question really is, should one be buying treasuries as a form of protection, or should be looking for an alternative that is neutrally, when you speak about this deglobalization issues and being tied to a certain economy and so forth, even from the aspect of not being having the same degree of default and inflation risk like you have with other assets. And gold provides that. That's the whole reason why gold has been money. And it's not to say it cannot coexist with Bitcoin or other cryptocurrencies, or maybe some other assets like oil, like silver. But gold plays a very unique role in this monetary system, especially when you have the issues that we have currently. I would say gold is near record prices right now, and I would suspect that we're going to be, a lot higher from here. It would surprise me if 5-10 years from now, gold hasn't doubled from here. As a money manager, when I had that view about 2 to 3 years ago, which some of that has played out. And I would go back even more, because really, if you go back to where we started really not only launched our fund, but really started talking about precious metals, was really late to 2018, early 2019. Our view was very clear. It's that gold prices are likely going to be higher 5 to 10 years from now. And if that's the case, how do I maximize and optimize the way to really make money on that trade, knowing that it is not buying gold that would do that? We never bought gold, really. If you looked at our portfolio positioning since we've had that view, it's not where we think most of the asymmetric opportunities really lie ahead. While there has been huge learning curve in this industry of mining and the ways to express that view in the markets for us and for me over the last 3 to 4 years, I think I have really formalized that view today. I think there's a lot of issues for why you're seeing the divergence between gold and performance of major mining companies. I think there's a reason why this whole industry has not attracted capital in a significant way. I think it's very different, even similar to oil, but the oil space is starting to realize something that the mining space hasn't really realized yet, which is companies are getting rewarded by being aggressive, by increasing production, by increasing capex, rather than the other way around of getting capital back to shareholders through dividends and buybacks. And that's still a fundamental change in strategy of the industry. If you look at the majority of the majors, their performance has been dismal, and that's mostly on the back of production not growing at all. Most of their production has been in a secular decline. So why would you put money into them when their businesses are not growing, especially in gold prices at record levels? There's really no excuse for them to be chasing new assets. But it's just on the back of such a chronic period of underinvestments, force most of those businesses to be so capital conservative. So sorry to go on a tangent here on the gold side, because to me, it's important to understand, how do you express that opinion about being bullish on gold? One thing is to have an idea in the markets. The second most important part on the back of a high conviction thesis is to, how do I express that opinion? And, that may change over the years as you grow that conviction and as you understand better the industry, and you understand better different ways to structure that trade. At the end of the day, this is not a trade even. It's really an investment over the 5 to 10 years. I think there is room for people to be creative in this industry. There's room for people to be as creative as they were back in the 90s with technology, when you saw the beginnings of venture capital and private equity backing technology projects, and people starting to understand that industry so well. Although that internet was starting of a new trend, the mining industry is one of the oldest industries in history. And although it is one of the oldest industries, very few people understand that market very well. I can count of how many people I know that can fully grasp this market with some level of understanding that others don't. And so it's very there's a lot of inefficiencies that will be exploited. It will surprise me if those inefficiencies don't get exploited in 5 to 10 years, because the market doesn't understand even the news of most of those companies. And I think there was going to be a need for this whole industry to be reshaped, and will require vision, and there will be room for new majors to be formed. And so I want to be involved with that. So I'm extremely excited because I have high conviction in this gold trade. But I don't think it's buying gold that will get you there. I think that the best opportunity is to build a business on exploration and development phase of the industry, and potentially creating the next major companies that will really capitalize from this trend in the next 5 to 10 years.
Yeah. So basically, if I was to boil that down, it's, if you're looking to preserve your wealth, maybe a portion goes into gold and treasuries to hedge against inflation, hedge against uncertain times. Now, what percentage of your portfolio, of your wealth, do you put into that actual hard asset? there's a lot of different schools of thought out there. But yeah, I agree with you in terms of the exploration piece of it. For gold, for silver, for these miners, probably more of opportunity, more upside there. Obviously, there's risk as well. But that's why, there's super smart people like you and others out there in the space that we go to look for guidance on that piece. So thank you for walking us through that, Tavi. Very detailed, and I think absolutely helps the viewers. I know we're pressed on time here, but I do want to touch a little bit on BRICS. I know you travel the world. You're an international traveler. You deal with all these global macro trends. I know we were just speaking before we started recording. You were mentioning that you do get to Brazil occasionally, and Brazil being one of the BRICS nations. I'd like to get your perspective on BRICS. And, we see a news story coming out, every day about BRICS. And do you think that has legs? Do you think that in the next, I'll even say maybe 10 years, BRICS has a chance of being a dual world reserve currency with the US dollar?
I'm gonna bet against that one. I think this is unlikely to happen. I think the world is becoming, I hate to use the word multipolar because it's been used so many times, but from a monetary perspective, I think that's the case. I'm very bullish on tangible assets. I just don't see the alternative for the dollar as of today outside of gold. When I think about China or the BRICS, I think we tend to look at them as a block, and they're not a block. That couldn't be farther from true. And the reason for that is because of the fundamentals of each of those economies and the way they're run. And I think that's an important aspect of it, because it changes how those economies will behave in terms of performance over the next decade or so. And that is, I think it's crucial to understand that, meaning China is a net importer of commodities. It requires to have a stable domestic economy to be able to purchase those natural resources over time. It requires it to have great relationships with different countries. In a world where I think commodities will be much higher in prices, I do not want to own an authoritarian regime that requires the purchasing of those commodities over time, because those are going to get extremely expensive. I think in 10 years from now, or even in between 10 years from now, we're going to see commodities reach some stupid levels that will make it very painful for China. I wouldn't surprise me if China significantly devalues its currency as a result of those problems. Understanding the same way you don't want to be buying a commodity-led economy throughout a commodity bust period, you don't want to do the opposite, which is buying a commodity-led economy, a commodity importer at a time when tangible assets are on the rise. I want to be far away from that. I understand from my history of living in Brazil and still have most of my families in Brazil, businesses in Brazil. What I understand is that while we like to focus on politics, the economy will lead the way. And in Brazil, when we've had issues, every single time we've had issues in emerging markets, are usually caused, or almost every time is caused by economic events. And so when we've had, for instance, in Brazil, the issue with the impeachment of the president, what was happening at the time was that commodities are falling apart. The currency was devaluing versus the dollar and other currencies. The Brazilian economy, because of that, had a huge amount of imports relative to exports, because their commodities revenues were in a severe decline at the time. And on the back of all that, you had inflation rising too. And so how in the world you're going to have political stability, which now, because of the economic collapse, is creating a social unrest? I think something similar will happen in China for different reasons, opposite reasons than what happened in Brazil. It's because of the rise of commodity prices will lead to a very difficult environment for China. That's number one. Number two is Russia. Russia is a commodity exporter, and you would think that could do very well in this environment, but it's also a geopolitical mess and has proven to be so for many decades and centuries. And it's just hard to believe that you're going to see institutional global capital chasing that market, driving the liquidity in that space in a big way moving forward. That's not my view. India, commodity importer. I don't think India is the next, the development we saw with China over the last 2 decades of this growth of the Chinese economy and becoming the manufacturing plant of the world and doing what they did in a certain way successful, even though I think there's a lot of flaws. I don't think India is going to the same path. I have a very different opinion about, I think, majority of market participants on this, and I'm happy to be a contrarian on this. That's number 3. Number 4 would be Brazil. Brazil is in a very interesting position. And I don't say this because I'm Brazilian. I am the most skeptic person about Brazil as you can find. I lived through it in the country. I know how corrupted it is. I know how difficult it is to start a business. My dad is a business owner. I have seen him had so many issues over the last decades because of it. Inflation has always been a problem, but I know that Brazil does very well during times when commodity markets are doing well. And if I believe in that for the next 5 to 10 years, and I find the majority of Brazilian assets trading at historical lows when it comes to multiples, even especially relative to where equity markets are in the US, to me, this is one of the most interesting and asymmetric ideas I can find. So I'm very bullish Brazil, the Brazilian economy. I'm very bullish South America as a whole. I think Brazil is not only a commodity exporter that has links to every commodity, agricultural commodities, energy, mining and metals, everything. And so it's hard to believe we're not going to see huge links geopolitically. It's almost like the Switzerland of the BRICS, because it will do business with China, will do business with Brazil, will do business with Canada, will do business with Saudi Arabia. It couldn't care less where your passport comes from. And so I like to separate the BRICS. I am very bullish on this, on that part of it. I like South America. I think South America will see Brazil as an example in a leading economy and will perform very well. I think there's opportunities in Bolivia, Peru, Chile, and I'm extremely excited about South America for the following years. I think they're great places to invest currently. And I'm less focused on this currency stuff because I don't know how that's going to play out. It's just so many uncertainties on, where is China going to be 5 years from now? I just don't understand that if the scenario I believe so strongly plays out, I just don't think China will be in a strong position anyways. So why would I be betting on a new currency being built by China in the first place, or with a link with China in the first place? I don't know. I don't understand it. I don't think China has the upper hand here. I think who has the upper hand are commodity-led economies. Canada, Brazil, the US, Australia is in that position. So there's some parts of the economy that will do very well. And the others are going to have to create great relationships. Otherwise, they're going to get screwed. Yep. That's Japan, that's Europe, that's China, that's India. Saudi Arabia is in a commodity-led economy as well. That's sort of my view. I probably surprise you with my answer, but that's where I am.
No, this is excellent, because what I like to do is for the viewers out there, and myself as well, we are fed a lot by the media, by social media, by the news stations, by the politicians. And some of this comes down to getting a different perspective. You're an international traveler. You travel the world, but you also follow the markets. And I need to give the viewers a different perspective, and not just what the media is feeding them relative to BRICS. I thought your answer was very elegant, a very elegant answer to my question on BRICS. And you two of the things that I thought you were going to touch on, relative to corruption in some of those markets, as well as demographic problems in some of those markets. Excellent explanation of why you're not pro BRICS, And those are two big things between corruption and demographics, adders to why, I'm not thinking we're going in a BRICS direction either. So we absolutely resonate on that. I think there's some other things that'll play out first, like central bank digital currencies and some things like that that'll gain some momentum. I know where we might need to schedule a part 2 for this, because there's so many different areas I want to go into to help the viewers understand the level of detail that you go through, Tavi, as well as Crescat Capital in terms of the research that you folks do. So one last question for you, though. What is your confidence level in the Fed and the Treasury to, earlier you mentioned, maybe it doesn't matter if we have a soft landing or a hard landing, we're in this quagmire with unemployment being at this historical low. Do you think the Fed is going to be able to direct us out of this mess that we're in, or do you think they're going to create further problems for us?
I always like to look at history as a way to pose probabilities. And so it's hard to believe you've reached such a level of speculation in markets and things will deflate in a very calmly manner. I don't think will be the case. And on the other hand, I do understand the constraints, the political constraints that are on the Fed right now and the government. I think the government imbalance of the debt and deficit is a huge problem. Understanding that ultimately the Fed will have to bring back stability to markets. But I'm talking out of terms because I'm talking about what I think will happen in the future. What I think will happen first is this break of credibility from investors relative to US Treasuries. I think we've seen some of that happen in 2020. And it's funny, 60-40 portfolios had an incredible, one of the worst years in 2022. Entire year was awful. And then you have first quarter 2023, things come back, which if you understand markets, things fall, go up, and fall. That's just normal. It's the same way when it goes up, and goes down. And sometimes those changes in direction in a short term can be very severe. And those are times that if you have a thesis, you want to almost double down on that. And it's almost like the market is giving you a chance to get out of those assets, meaning mega caps, seeing how much mega caps have risen recently. Why do you think that is? It's because 10-year yields have declined and the ultra long duration type of asset that is linked to 10-year yields is mega caps. I mean, mega caps, when you think about them, you're extrapolating free cash flow all the way to 20, 30 years from now. People thinking Amazon's going to be here 20, 30 years from now, the same way IBM was and things like that. And so it's absolutely normal to see that huge run up in those shares or those stocks when you have a 10-year yield declining. Now, do I think that's sustainable? No way. I don't think that's sustainable. I think the 10-year yield will probably rise again. We're going to see the same turmoil we saw with the UK when the BOE had to step in and buy those bonds.
Yep.
I think I'm watching the clock here. I think it's going to happen. I am very confident that probably that's going to be the case here in the US at some point. And so the question is, what happens if you see another 15, 20% decline on treasuries? Thinking about the unintended consequences of that in markets where people got wrong-footed just recently by thinking US banks are fine, but then realizing that there were major mismarkings of valuations in their balance sheets because of the decline in fixed income market. Well, what about private equity? How would banks today behave in the market right now if we see a 15% decline in treasuries from here in the next 12 months? Yeah. How would banks do? Would the Fed have to step in? Of course.
Yeah.
And so we know ultimately the Fed has to step in every time we have a liquidity gap. So I'm not concerned about the liquidity gap. I'm concerned about the intervention in order to avoid those liquidity gaps, which goes back to this idea of owning tangible assets. And I think there's a major correlation we'll be breaking in the following months. It will surprise me if that doesn't happen, which is treasuries falling as gold rises. Watch what happened in the 70s. That was precisely what happened. Who cares about, but yields go higher. Investors are getting paid to own that. they're likely to own that more than owning gold that doesn't yield anything. Look at what happened in the 70s. There was a major divergence between those two. The correlation was as negative as it could be between treasuries and gold. And the reason for that is because there's something called inflation risk that needs to be priced in. And then on top of that, you get the default risk, which has been priced as zero, along with inflation, has been priced as zero as well in treasury markets. That's not the case right now. And so, and the treasury issuances that we're not even talking about, the supply side of it, which is a huge deal. So sorry to, long answer again, but that's what's in my mind. It's all this unfolding, and I don't think the Fed has a good handle of this. And so they're trapped, they're hamstrung. I don't blame them. If I was in the Fed, running the Fed, I wouldn't have an answer for it. I don't think anybody has an answer for it, unless we just want to go through a depression, which would be raise interest rates appropriately because of the inflation problem, kill the inflation issue. As you do that, you're killing natural resource companies. There's no answer for it.
Yeah, politically, the politicians would not allow that to happen.
How would you do that? And on top of it, we know that natural resource, I invest on them. Access for capital is just so difficult for those natural resource businesses that require that in order to have CapExes going higher and increasing supply of natural resources for the next 5 to 10 years. You don't put a mine into production in 2 years. No way. That takes 15 years or so, in average, for the ones that actually are able to become mines. Majority of them don't even become mines. And so the probabilities or the numbers are so skewed towards the ones that actually been successful. So look, I don't think there's an answer for it. I'm not claiming here to be the guy who should be running the Fed at all. I think anyone running the Fed would be screwed in this under those set of circumstances. And so we as investors need to know the situation, understand as best as we can, see where the flaws are, what the likely, the rules are going to change of the game. And we got to understand what are the likely rules that could be, changed. Will the Fed really support the Treasury at some point? Are those Treasury concerns that I have real concerns? I think they are. And what's the likelihood of assets that will perform well or not well over the next 10 years if that environment plays out? And, that's what I spend my all day thinking is, where do I put my money in this environment?
So today you've given the viewers a tremendous amount of value. And I think what it does is it helps folks construct their own thesis. Whether they agree or disagree, it helps them solidify what their thesis is, where their investment dollars should be flowing, and where their thoughts are relative to the Fed, relative to treasuries, relative to gold, relative to miners and equities. And, this is what we're looking to do, is we're looking to spur some thought out there and make stronger investors and be able to educate folks along the way, which, Tavi, you do an excellent job with. So in terms of, how can the viewers find you? Where's the best place for them to go to hear from you? Is it Twitter? Is it your website? Where can people find you?
You can find me on Twitter at Tavi Costa, and my website is Crescat.net. It's where we share most of our research. And just a final thought, I try to spend most of my time, while I love analysts and I love watching some of the commentaries out there in terms of markets, I think it's not very helpful to hear people talk about markets without the risk reward hat, because that's the hat that we all have to wear when we're running money. No one can speak with the level of certainty that some of those guys talk out there. I hear some people say, for instance, wow, I could certainly have, how predictable was this SVB banking problem? Was it predictable? Were you short the bank? Did you make
Probably
money on
not.
it? Yeah. I don't know anybody. I know a few people that made money on this that were not even being interviewed by others. And so to me, why? Because they thought there was a good risk reward bet there. The majority of people that predicted SVB didn't even capitalize on it. So I don't understand that very well, why people like that get so much credit for it. But I'm not here to change the game either. I'm here to manage money and think about, how do I do things in terms of a risk reward perspective, understanding that everything works on probabilities. Everything I said here, I am just using historical context to help me use those probability scenarios of what likely will occur. A lot of the things I said never happened before. And so it's very difficult to model things, but I can make assumptions and ideas throughout this sort of framework that I'm creating. And so I think it's quite helpful to think on a risk reward basis every time in your life, and not just to run money, but also to in any decision you make in life. And so anyways, that's my message out there. But with
No,
that, thanks.
it's a great message, Tavi, and I appreciate so much having you here with us today to share that message, help us construct our own thesis, understand that there's a lot of history out there that we can fall back on, going back 100 years. But we also are in a different environment today. There's a lot of manipulation out there. And I can see the look on your face. And again, maybe we'll save that one for part 2. But yeah, there was a lot of great content that you created today. I hope the viewers enjoy this, and go to your Twitter feed, go to your website, look for more research articles there. And Tavi, I can't say enough. Thank you so much for being with us today.
Thanks for having me, Tony.